I'm in Temecula, California. My company, BluSky Equity Partners, I founded about 5 years ago, but I actually started getting into real estate syndications and apartment investing about 9 years ago. So been doing this a little while, gotten through quite a few transactions, and want to, love doing this, love helping people, and it's a great business to be involved in. Brett and JJ and I are involved in one deal together right now in Fort Worth, Texas. And potentially gonna keep on working together in the future. We're actually working together right now on a second deal together called Midtown First in Tucson that we'll mention a little bit more later. So with that, I'll turn it over to Brett and JJ to introduce themselves. Oh, real quick before I do that, if anyone on here, I'm pretty sure everyone here is already in our investor clubs. These QR codes are just for if anyone who is not in our investor clubs yet who wants to set up a meeting with us or something like that. Or join those. That's what those QR codes are for there. But other than that, turn it over to Brett and JJ.
Thanks, Greg. I'm a part of the Better service. He's a Marine. I'm an Air Force, so we won't hold that against him. But in any case, I'm actually 19 years Air Force as we speak. Got less than a year left and we'll be retiring officially, but still in the W-2, but working from home from a process improvement, black belt type environment consulting and for the headquarters, just educating them and on how to better improve the way we do business. Obviously, the military is in much need of that, and we're reducing the amount of people that are in our military, so we're having to figure out ways to do business better. So no better way to do that than to improve the way we do business. So, which is awesome because I've been in healthcare a majority of my career, running hospitals. It actually runs right into the syndication model that we do today because you're an expert in nothing, but you're the glue that keeps the operation together, which is what we do in the syndication world. Like we have experts that surround us in every piece of it, and we'll go into that in depth here. Which is awesome. You can have those experts who are very intricately involved in what they love to do, and you can have that team and those resources. So, yeah, it's a pleasure to meet everyone today. I'll put my contact information in the chat, and like Greg said here, we did want to make sure that we put these QR codes because this will be recorded and it's going to be sent out. And there's going to be a lot of folks that are going to be watching it and that aren't in our investor club that want to see those opportunities that we have coming down the pipeline that Greg had mentioned there. So that's kind of me in a nutshell. JJ, I'll pass it over to you and kind of highlight where we're at from the asset management side.
Hey, Brett, real quick, you said that the government needs process improvement. Say it isn't so.
Nobody on here knows that.
Yeah. Hey, real quick, could we ask folks to mute themselves for right now? If you need to unmute to ask a question, please do so. But other than that, thank you very much. There is some noise coming back there in the back end. Thanks a lot. JJ, take it away.
Sure. Thanks everyone for joining tonight. I'm JJ Hadley, the better half of the BAB Badass Bros. A lot of people in our company, they think that the BAB means bald and beautiful, but it's not. It's Badass Bros. But I just want to give a little bit of background on myself. I worked as a Trona mine for the last 10 years. I was overseeing all the projects, the project management, asset management, keeping the plant running. It kind of fell into the syndication world too. Is one of my specialties. Is that's what I feel like I like to do. Is I like to run the business plan from the time we close a property to the business plan all the way through to the close. So I like overseeing the contractors, running with the property managers, and so that's what later in the slideshow we'll go through like that certain aspects of the deal. And I'm the hammer, so we like to do the asset management side. And yeah, we just started smaller multifamilies in 2019. My brother and I, Brett, and we get at our first LPs as we'll go through the presentation of the pros and cons of both. But we started as an LP investor and we got about 300 units before we did our first GP syndication with Greg down in Fort Worth, like you said. And then we're under contract right now with another deal with him in the 94 units. So we're just looking forward to getting those deals closed and thanks for everyone joining, and enjoy the presentation.
Yeah, I just want to clarify too, LP being a limited partner, passive investment, kind of a investment for anyone who's not familiar with that terminology. We don't want to speak too much terminology here without defining it, of course. So.
All right. So who do we have here right now, and who is this? Kind of what are we wanting folks to see, and where are they coming from? We've got the BluSky Investor Club from the Greg side. We've got the BAB Investor Club members from our side, JJ and I. And then we just have the folks who are guests and others who may be attending just from a referral service. And we want to make sure that we throw that out there. If you have family and friends that are interested and are even, hey, this is something that you should be looking, invite them. We would love to have them a part of these meetings to educate our tribe, if you will. And so we have that on a nonstop basis where I'm getting phone calls or getting people booking some time with us, and we don't know who they are, and then they express that they're a family member or hey, a friend of so-and-so. That's the ones we love, and continue to please do that. Send them our way. That's what our passion is to help our tribe get to some of the things that we're going to talk about today. Next slide. The purpose overall, what we want to get across today is, hey, we all hear about the stock market and what's happening out there, things that we don't have control over. We want to have that angst to be put into, no kidding, something that is tangible and something that you can see. And that's what I teach my 12-year-old and 8-year-old on a daily basis as they're playing cash flow for kids. Like this is something you can do, and you can have either active investments or you can have passive investments. And that's what we're going to talk about and engage in today, is that, hey, there's multiple ways that you can make money in real estate. And it just depends on some of the things that we're going to talk about today. How active do you want to be? And hey, if you're financially free, well, how can we build it even bigger and make a bigger legacy to continue that on? And it's all about the impact that we're going to have and create for others, right? And so that's what we want to, that's the purpose of this right now. Not only this one, but in the future webinars that we're going to have, future meetups. It's going to be awesome because we're just going to have this discussion. And if there's an opportunity that you guys are hearing that you want to ask a question about, feel free to interrupt us and let's talk about it, because that's what's going to, we want the engagement. Next
Absolutely. Any questions at all, unmute yourself and feel free to ask.
So today's meetup, we're going to talk about active versus passive. And JJ and Greg had mentioned that previously we've been both, which is we've seen both sides. And that's the most important, is why would you listen to somebody that hasn't done it one way? And so we've done it passively, and I highly recommend, and I think everybody on this call would recommend as well. It was a very good way to approach the syndication world when we were just starting out. Is a good way to learn it. Not only that, is that you're going to be involved with people who you know, like, and trust. And now you have our QR codes. You have our ability to come on our monthly calls and, no kidding, say, hey, what's this? And that was the most beneficial piece of passive investing, is that you have the ability to reach out to us and get clarity on something and not have to make the mistakes. Next slide. So the ways that you can participate in a syndication, I don't want to dumb it down for those who have already been involved, but here for those who have and have not, this is kind of the different ways that, like Greg was just mentioning, the different ways you can invest in a syndication. And that is the limited partner. Those are the folks that are bringing the capital. So those are your passive investors that are getting the mailbox money. Those are the folks that have full-time jobs or have other priorities. Some of the things that we'll talk on the next slide that need and want other avenues of tax benefits, other, in mailbox money, that money's coming in and they don't actively have to be doing anything within the investment themselves. What's important about that is that you know, like, and trust the active investors that you're investing with. You're not investing in the actual deal. You're investing in those people that are going to make things happen. And not all deals are going to go smooth. And you want to know that you have a 20-year Marine vet that has gone through. That's why Greg and I and JJ invest with each other, because guess what? We know when the going gets tough, we are going to get going. And we've done that. And we've seen that.
Yeah.
And that's what I highly recommend, that you actively go out there and you do the due diligence on your deal sponsors, which is number 2 right there. Those general partners that you're investing with, it's more important that you do the due diligence on them than it is for the deal itself. Because they know if you're investing with a general partner that is going to be actively pursuing the due diligence, hey, they've already done that. And so I've had multiple times in investments that people come in and invest with us, and they do it through a text message. Because if a good family offices and individuals who have done investments, they know good investments. But more importantly, it's the active general partners and the sponsors of the deal that are more important. And that's what we want to get across today. And that final piece is the key principle. Sometimes we're doing much larger deals, 200 plus, 300 doors, and the bank is going to require much more net worth. And so you bring these key principles on board, and they act as the net worth and the liquidity for the bank requirements, the commercial bank requirements. Is there any questions, or I'll stop right there. Is there anything that anybody has any questions on, or Greg or JJ, do you have any further information?
Yeah, I'll tag in real quick, Brett. And that's just that in normal order of progression, most people do start off with as a passive investor, and certainly recommend that as a way to get started. But if you have goals of becoming an active investor and a deal sponsor yourself in your own right, then make sure you're investing with someone who's going to take the time to explain things to you and answer your questions. There are a lot of folks out there that they will, they're welcoming you into their deal, and they'll answer any direct questions, but they're not trying to spend a lot of time doing, mentoring someone like that. So there are plenty of people like ourselves out here who will take that time and do what we can to help you learn if that's the direction you're going. Because at the end of the day, we want you to be comfortable and confident in this style of investing and in investing with us, if you choose to invest with us. Last thing, the key principle and guarantor, we're not really going to spend any time after this slide talking about that. But for folks who are higher net worth, who can contribute something to the balance sheet requirements that are necessary to get these loans, that is an alternative way that people can participate. It's still passive for them, but they have to provide their proof of their financials up front, and usually once a year after that. So typically, you might even be able to get a small portion of the general partnership share for doing so. So that's a way you can increase your own returns. But at the same time, that does increase your risk exposure also. So you want to make sure you're only doing that with sponsors who you have full faith and confidence with. So. Again, any questions right now, or JJ, do you have anything else to add in?
No, that pretty much covers it.
I've got a question.
Sure.
Yes, please.
Awesome.
I've got some properties that are under leveraged that I'd like to sell, and but I'm looking for 1031 opportunities to get into that are more passive. So, is there an opportunity with you folks to do deals where I could be a tenant in common with the general partners, for example?
That's absolutely possible. JJ and Brett, I don't know if you want to give more of the reply on this. I know John's came here through you guys.
John, on most of our deals, I don't want to say all, we do have the opportunity to do 1031 exchanges. The problem being is just not the problem, it's just the opportunity for success, if you want to call it, is that it needs to get done at an expedited fashion. So in
Right.
most deals, we have the ability to bring 1031 funds on just because of the length of time that it takes to close. But
Right.
there are deals that we can't just because of the closing is going to be quicker than most. But JJ, do you want to add on any more there, or Greg?
Yeah, usually they have to be drafted when we start the syndication process, right, Greg? So I mean, it's usually when we start with the syndication attorney and we're going through all the legal documents, that's when we will decide at that point if we're going to accept a 1031 or not.
Yeah, that has to be fairly early in the process, just because that affects how the organizational structure for the deal. Have to organize in the right way. There's some extra agreements that have to be drafted, and because of all that, there's some additional costs. And so, and because of that, is usually that would only be accepted in for certain levels of investment. For some sponsors it might be 500,000 or more. For some sponsors it might be $1 million or more. It just kind of depends on the deal and who you're investing with. So for us, it would depend on the deal. So,
okay.
Okay,
thanks.
absolutely.
I know we talked a little bit about this. Good question, John. And if you want to further that conversation later, let's definitely do that, and we can get you more additional information as well. And depending on what timeline you're doing, and so we can dive more deeper into that question as well, depending on your circumstances and whatnot, and what deals we have in the pipeline as well. Okay. And this is kind of the things that I know we've already chatted about some of this or most of these, but these are the things as an active investor versus a passive investor, some of the things you need to be thinking about and some of the things we think about as we decide, are we going to invest passively? And sometimes it's both. Sometimes you're a GP and you're a sponsor, and you're also investing similar to our Tucson deal that we're going to talk about. Yeah, absolutely. When you have such an incredible deal, you want to make sure you're doing both. And that's what we want to make sure that you can understand, that you can do both and get paid twice, if you will. And 3 times if you're talking about the cost seg and some of the things that we get paid from that perspective as well. So that's what's amazing about real estate, is that we have the ability to do that, which is what that first one right there, the profits. You got to really think about the time and your priorities in life, where you are at as far as your investing strategies. What does that look like? Some of the risk that Greg had mentioned there previously, like how much risk the risk management. Are you willing to accept a little bit more risk to have a little bit more reward? And the control, how much control do you want to have on the deal? As a limited partner, do you know, like, and trust the active investors that you're investing with? 100% if you're taking our recommendations. And do you okay with giving up that control with those individuals, because you know the types of individuals they do and what the work that they do? And then the teamwork. That's what I love about the syndication. Greg has totally different expertises than I have. Then you bring these team players to the table, and they are also helping you get educated on the things that you may have weaknesses in. But the folks that you're surrounding yourself with are the folks that are going to help you get that to the finish line. Not only to the finish line as from a contract perspective, but also executing that business plan that JJ had talked about. It's so important, and I can't believe that he is so excited about asset management, because if you know syndications, there's not a lot of people out there, and Greg can attest to this. There's not a lot of folks that are so excited about that. So when you find those folks like JJ Hadley, they're few and far between. Because
it's so important to do well. So critical to do well. I've always loved the saying too, that if you want to go fast, go alone. You want to go far, go as part of a team.
That's right.
Absolutely. And it always goes to how much resources you have available at that time. What does it look like as far as, like you said, that's why I was mentioning to the 1031, like, John, like, hey, what does that look like as far as what is the timeline? And sometimes the timing doesn't work out. We've had numerous times where, hey, the timing doesn't work out for us, but guess what? Since we are a part of this phenomenal mastermind groups that we are a part of, whether it be the Sumrock group, whether it be the 10X Vets, the Service Academy Business Master, we are a part of a group that has phenomenal people doing good things. And if we can't help you on our specific deal, guess what we're going to do? We're going to refer you to one of our people that we know, like, and trust, and you can get in touch with them as well to see if there's an opportunity in their world to make sure that we get your money working for you. So those are just some of the things you want to think about and consider when you're trying to decide if you want to passively invest or actively invest. Next slide. I'll turn it over to Greg.
All right, so this is my section here. And if you hear my dog in the background, sorry about that. This is the worst possible time for me to take over a slide because my wife's just getting home and my dog's going crazy right now. So we're going to talk a little bit about the profits. The profits is the first thing that people think about. So that's something to really understand the difference between profits for a limited partner and profits for a general partner. Obviously, a limited partner is passive. There's no real work required. General partner, it's a lot of work. There's a lot of work that's required. So you get compensated accordingly for that. So the types of returns, the types of different income streams that are possible for both of those. Limited partner gets a simple thing. They get the return on their investment, the limited partnership return. That might be a portion of a straight split if the deal is organized that way, perhaps an 80-20 straight split where 80% of the profits go to the passive investors and 20% go to the sponsors or general partners. Or that might be something where it's using a preferred return model, where the first, say there's a 7% preferred return followed by a 70-30 split. That means all the profits go to the passive investors or limited partners until such time as they've received a 7% annualized return. And anything after that, above that, would be split 70-30, with 70% still going to limited partners and 30% going to the sponsors. And then on the back end, when the property sells, same thing. After the original investment principal is returned, then 70% of the profits go to the limited partners and 30% goes to the general partners. But that might sound like a raw deal for the general partners, but I assure you it's not, because there's a lot smaller number of general partners. So that's how that works out. And I'll show you here an example of what that actually looks like. So for the general partners, well, we usually get a limited partnership return too, because we invest in our own deals. So whatever you get for investing, say $100,000 in the deal, we get for investing $100,000 of our money in the deal also. So that part is just apples and apples. Okay, but there are additional streams above that. So there's the general partnership return, which in the example of that 80-20 straight split, that's the 20% that is retained by the general partners. Okay, we call that general partner shares or GP return, or carried interest is another term that's used for that. Then there's an asset management fee typically. That's usually between, on most syndications I've seen, it's between 1.5% to 3%. We usually keep it in the 1.5% to 2% range of the monthly income that comes in, that the property takes in. And that is for the active work, and it is very active, of managing that asset. In fact, for that work, that's actually kind of a small fee on that. Then there is, and whether, maybe there's a lot of different ways to organize a general partnership. Perhaps not everyone is sharing in the asset management fee. Perhaps only a couple people are. It just kind of depends on how the general partners structure the deal, structure their own management of that deal. There can be, it doesn't have to be, but there can be an acquisition fee on the front end, and that is usually calculated as a percentage of the share price, the purchase price. Usually 1% to 2% of that purchase price that would go to the general partnership. And that is for the cost. There is quite a bit of cost. Subscriptions are involved and everything else in travel and going out and looking for these deals and pursuing them and negotiating them. And typically for every 100 deals that come across your desk, maybe you'll get one under contract. It really comes down to that. You get 100 come across your desk, you rule 70% of them out within the first few minutes based on a quick hasty analysis. Maybe 30 of them are justify a more detailed underwriting. Out of that, you might put 8 or 10 letters of intent out to make a purchase. And out of those, you might actually get 1, 2, or 3 under contract, something like that, in a given period of time. So there's a lot of cost that goes into that, and the acquisition fee is meant to pay back for a portion of that. It's also a good way for sponsors to be able to scale, to be able to use that to hire additional team members to be able to take on additional and larger deals. And some sponsors will also charge either a refinance fee if the deal is refinanced, or a disposition fee on the back end when it eventually sells. If they do that, it's typically 1%. I'm not saying advocating for any of these fees necessarily. I'm just saying this is what's common in the industry. One thing that sponsors, general partners, have to be careful of is not to go overboard with the amount of their fees to keep things equitable. So, what does that look like? I'm going to give an example here based on a property that we purchased for $10 million. It's going to have a 70% loan to value loan. So that means that we're going to have to raise $3 million as the down payment for this property. And then it's also going to have a $1 million budget for capital improvements and reserves. So $4 million total investor equity that's going to be raised for this. We're going to ignore for the time being fees and cost of the purchase and stuff like that. Okay, we'll just keep things nice, simple example. I'm going to say we're going to hold this for 5 years long, and that the property generates a 7.5% average annual cash flow. And that's at the property level. That's not what the investors get. This is just what the property makes, and that is split then between the limited partners and general partners. And then at the end of 5 years, we're going to sell it for $12.8 million. So there'd be $2.8 million of profit on this deal. This is a very reasonable example, and oftentimes I've seen a lot more growth than this actually. So what this looks like for limited partners, for passive investors. For passive investors, if it's a 6% average annualized cash flow, it's going to be smaller in the front end, larger in the back end. So it might look something like this. This is just for nice round numbers, okay? 4%, 5%, 6% across years 1 through 5. So in terms of dollar amount, and this is based off of a $100,000 investment, which is 2.5% of the total equity raised, that $4 million. And then the deal structure is going to be an 80-20 straight split. Okay, so throughout the course of the 5-year hold, they're earning about $30,000 back just in cash flow. Okay, and then in year 5, when the deal sells, they get their original capital back, plus they get their proceeds from sale, which 2.5% of $2.8 million total profit is $70,000. So that's how that comes out. So that the total profit they're getting is the $30,000 from cash flow plus the $70,000 from the proceeds from sale. So $100,000. Then you add that to the return of their capital, and the total cash flowing back into their bank account is $200,000. This is also called a 2x equity multiple, or 100% total return, because they invest $100,000 and they get $100,000 in profit plus their original $100,000 back. And this is a very reasonable example. And this is roughly the kind of deals we're looking for, where we can expect to double people's money in about 5 years or less. So that's what it looks like for the limited partners. From a general partnership perspective, okay, remember I said it's 7.5% average annualized cash flow on the property level, which turned into 6% for the limited partners. That's because of the 80-20 split. So the additional 1.5% average is what the general partners get. So that for the general partnership as a whole, not individual general partners, but just the whole general partnership team, this is how that translates. That comes into for cash flow, it looks like 40,000, 50,000, 60,000, even based off of this smaller number, because this is a percentage of the overall equity raise, percentage of $4 million. Okay, so that adds up over the course of 5 years to $300,000. For the 80-20 split upon sale, the 20% equals $560,000. So the total GP return from this would be $860,000, and this would be split among however many general partners are part of the team managing this property. So besides the actual shares themselves, then there's those additional fees. So say, for example, there's a 2% acquisition fee. Then that on $10 million, that's going to be $200,000. That would be upfront during year 1. Then asset management fee, we're going to say 2% of monthly income, just to keep things simple. It would actually grow over time and be a little less at first, but just to keep things simple, I just said $12,000 a year, so $60,000 total. Disposition fee, if there is one, might be 1% of sales price. So we're saying we're sold for 12.8 million. So there's $128,000 in year 5. So when you add this all up, it comes to a pretty darn decent amount of just about 1,250,000 that is potential for the entire general partnership team. And when a lot of investors see these kinds of numbers, this is what makes them decide they want to become active investors. But there's a whole lot more to it than just the profits, which is part of the whole point of this conversation today. So here's what it might look like if, say, there's 3 GPs. Say it's Brett and JJ and myself. As 3 GPs on the GP team. This is what it would translate into on an individual level. So about $100,000 worth of cash flow over 5 years. Close to 200 grand from the sale in year 5. So the total return would be about just 287 roughly on that, and that's just on the general partnership return, which means this is not for any dollars we have invested ourselves. This is for the work we are putting into this property to find it, and then over the 5 years of owning it. But we also do invest in our own deals. So here's what it might look like with this previous 286 over 5 years, plus our own LP return if we invest $100,000. So this is what the cash flow looks like. Ends up being 130,000 after 5 years. The profit on sale from both the LP and GP shares would be almost 387. So total GP return about $487,000 for a $100,000 investment. About 500% ROI almost. So that's a darn good investment in anyone's opinion. Okay, you just have to make sure that you're willing to accept the extra work and the risks and everything else that goes with it. And then after that, the share of the fees. So a third of the 200,000 acquisition fee would be almost $67,000. A third of the 12,000 a year asset management fee would sum up to $20,000. Share of disposition fee. So all in all, really we're looking at like over $600,000. So make that like over a 600% total return for the active investors. And that's why one reason people want to get into this. Now, these days it's more common also to have a lot more sponsors than just 3. We're seeing larger general partnership teams these days. So the more people are on the team, the smaller everyone's share of the pie gets, of course. And for now, this slide, I'm going to turn it back over to JJ.
Thanks, Greg. So yeah, Greg went over the numbers of what that looks like, and like he said, now we got to decide about the other things that he was talking about, the time, priorities, risk, that kind of stuff. So you got to decide, how much time do you want to put in, how much time do you have to put in. A lot of our investors are, like Brett said, have W-2 full-time jobs, and they don't have the time to be a general partner to run the property, because every property we buy and syndicate, it's like opening a new business. And so we may be running a 60 unit in Fort Worth. That's a different business. This 94 unit in our Tucson that we're closing in a month or so is going to be a different business. So it has different teams, different, property managers. We've got to oversee it. It's just a different business plan. So it takes a lot of time, like Greg said, to be the general partner. That's why a lot of people that get started, they do the LP or limited partners because they don't have the time. And then when you do have the time, is this how you want to spend your time? Because like Greg said, it's a lot of work. There's some late night calls. Things happen, go wrong, and you've got to fix it. So it's matters if you want to be the general partner and spend that time doing that. And then it just depends on where you're at with your life. Are you getting ready to retire? A lot of our investors use their self-directed IRA or solo 401ks as retirement to invest with us. So they're on a different level than someone that wants to do as a general partner. So a lot of the people that do the LP or investors, they invest with that because they're trying to use that nest egg to at the end of the retirement. But if you're trying to get out of your W-2 job like I did a couple of years ago, you got to have that cash flow coming in of multiple properties as a general partner, because it's going to be really hard to make the kind of funds that you need to do with the limited partnership. And so general partnership just gets you there quicker. So you just got to decide which one you want to do.
Yeah, I had a conversation a couple days ago, JJ, with a lady who, pretty sure you know her. She's been involved in one of the multifamily groups that we're part of, or have been a part of. And I thought that she had been a deal sponsor herself, and she said, "Oh no, I'm only investing passively. I'm trying to. I retired recently, and I'm trying to be truly retired." For her, the extra the profits were not enough for her. The time freedom was more valuable to her than the benefits of being a general partner. So that's a choice that's not going to be the same for everyone, and everyone has to have do that math, that personal and mental math, and figure out, okay, what is it that I really want in life? Am I trying to change careers? Do I want to get into this and become a full-time, multifamily operator? Or do I really just want to invest passively, and so I can, go camping on the weekends and enjoy my life, So
Yeah, being a general partner, there's nothing about mailbox money. It's all active. So from start to finish.
yeah.
So Greg, can we touch a little bit on, I know a lot of our investors are high net worth individuals who are very successful in what they do. Can you touch just a little bit on the cost segregations and what tax benefits that you receive from as being an LP versus a GP?
No, Brett, I don't want to do that. No, I'm just actually, there's a purpose I didn't put that into this, because it's not super different. Typically, in most deals, the tax benefits, the depreciation, will go 100% to the passive investors until such time as they have enough depreciation to zero out their capital account. Okay, so if they invest $100,000, once they've received $100,000 of depreciation, after that, it would be split between the passive investors and general partners, according to whatever the structure is for that deal, 70-30, 80-20, whatever that is. So for general partners, I will say that you get a little more because you get your share as a limited partner if you're investing in the deal, but then at some point you will get more for being a general partner as well. So there's that. I'll also say that if you're doing this, especially if you're doing this full time, but once you can transition away from any other W-2 job and do this full time, well, that's when it gets really good, because then you can take advantage of real estate professional tax status. And explaining that is a little beyond the scope of this presentation, but with real estate professional tax status, any type of loss can offset any type of income. Whereas without that, a passive loss, and the reason I'm saying loss is because even though these deals make money, the depreciation makes it look like a loss for tax purposes, and so it can help you out through taxes. So that paper loss, if it's passive, can only offset passive income. It can't offset ordinary income from a W-2 or 1099 kind of job. But with real estate professional tax status, it absolutely can. So there are definitely some tax benefits to being on the general partnership side. So.
Thanks, Greg. Most importantly, I just wanted to, make sure that our audience understands that, you may have a high earner in the family, but let's just say the spouse is a stay-at-home or has their own job, or whatever the case may be, has their own. They can also qualify for a rep status as well, which then you can use that money to take away the earned income from the individual with the high earn. So that we have several of our investors that are like that and in that bucket, that are either attorneys or in my case, being in the healthcare world, many of mine are doctors, and they're trying to figure out how do they reduce that tax bill, because that's that third way of making money in real estate. It's not all about the money you make. It's all about, sometimes it's about the money you save. And no, you don't give it to Uncle Sam to use, but I just wanted to throw it out there.
Yeah, absolutely. And that reminds me of two conversations I've had this week, actually. One was with a gentleman who He and his wife own their own business. They both work in it full time. They don't own any real estate besides the house they live in. They're looking for tax benefits, but because of that situation, they cannot qualify for real estate professional tax status. And so the investing in a deal like this is only going to do so much good because it'll be great for the profits, but as far as the tax side of things, the paper loss will not be able to offset their ordinary income. But then I talked to someone else this week who they own several short-term rentals in Florida. And this is an investor in the deal that we have together actually. And so he has several short-term rentals in Florida. He works full time, but his wife is the real estate professional, already has declared that for tax status, managing those rentals. And so because of that, investing in a project like something that we are doing that has the benefit of the massive amounts of depreciation that we can get in year one, they can use that to offset his W-2 ordinary income, and that's the ideal situation to be in, because you can really drastically reduce your taxes that way. That's one way that you can get where you can actually legally pay no income taxes in a year, at least at the federal level. The state varies state by state on how they treat all that stuff. And by the way, disclaimer, none of us are CPAs or attorneys. So, we're just talking about what we know as investors, what we've experienced, and the stories we've heard. So by all means, go get your own tax advice and legal advice. Don't take it from us. So are we done on this slide, guys?
Yeah.
Next slide.
Okay.
All right. So now let's talk about the risks that go along with being a GP. The big thing is when you first go out and look for a property, you're going to have to, guarantee that loan. Most of the deals are non-recourse, but they're going to still require the GP team to still bring in a certain net worth, a certain liquidity, and require a certain amount of guarantors on that loan.
Can you say what a non-recourse loan is real quick, JJ?
What's that?
Can you say what a non-recourse loan is?
Non-recourse loan is a loan that is going to be backed up by the property. So a recourse loan is going to be backed up by your personal credit, basically. And so this property will be backed up. If you go out and buy a $10 million apartment, the loan is going to be backed up by the property itself. So if it does fail, they're going to come and take the property itself first. But there is, like, the bad boy carve outs is that you still have to guarantee that loan. So there's still going to be some legal side coming back. It could be coming back on you. So that's the risk that you're taking as you're guaranteeing on that loan as a GP. Lawsuit. There is a possibility to get sued as a GP. Some things go bad with investors or a bad partnership. You could get sued by the tenants, but we cover the insurance for that on a property basis. So that covers that side, but there is a risk of being in a lawsuit. And then the main thing is that you got to have enough responsibility because you're handling other people's money, and it's not just $100. We're talking millions. And so like Greg, one of his favorite things is you got to be willing to take bullets for your investors. And so when not every deal goes as 100% planned, and so you got to make sure that the GP team is strong. Like Brett said before, you got to come together through those hard times and reserve that capital, because that's the most important. When our investors invest with us, we are there to preserve their capital.
You stole my thunder, JJ. I saw a later slide too. Oh well.
So yeah, but another thing you got to think about is control. How much control do you want or need to invest? You got to find the right team to invest with, and are you comfortable with that team to manage your money? As an LP, you're pretty much going to be just a passive investor, like we said, just a mailbox money. But as a GP, you got to be able to work with other GPs on the deal, and and trust that they're going to do the same thing as you are. They have your same business beliefs in there. And then, are you comfortable sharing the profits the same way, working with teams? The GP, you will not get this multi-billion-dollar apartment complex by yourself. If you do, you're well more off than I am. But a lot of them is going to take teams to take down. We're looking at, the property we have right now is a $13.6 million property. So it's going to take a certain liquidity, net worth, everything as a team take that down. So that's just a part of that, the teamwork. I touched bases this in my introduction, but this is basically the GP roles in the syndication. So as you can see, number 4 is the hammer. It's the asset management, but it starts with number 1 is the deal hunter. We try to find certain aspects in a GP deal when we first start going out and looking for someone that each one of us is either going to take one of these or be involved in multiple of these. We all want to have a role and know exactly like what the underwriting looks like. What the deal, if it's a good deal when we go to look at the broker, have broker relations, we all want a capital raise, and most of us don't want to asset manage, but there are certain asset managers that like to. But the number 1 is the deal hunt finder. You're going to go out and find the deal. He's going to be the one that going to be dealing with the brokers, building those relationships, trying to get off market deals. And his email is going to be blowing up constantly with new deal flows because he's just got so many broker relations in certain markets. Once we find that right deal, like Greg said, we all fly out. We say, all right, we found one. We underwrote it with the brain. The number 2, the deal architect, is basically he's going to underwrite the deal. And when he finds it, we're all going to fly out and we're all going to meet and go over this deal, because is it a good deal? You know, we'll do a halfway due diligence when we inspect the property, when we go to view it with the broker. And if the underwriting works out, we'll get it under contract, and that's when we start opening it up for funds with the capital raising. We're going to need, a certain amount of money down to close the loan, and then we'll most likely need money to renovate the property, because we like to buy multi-value properties that need some capex. And
Value add, you mean?
yeah, value add with value add that we're going to oversee, and that's what basically the asset manager does. He's going to oversee that value add, the renovations, because when we renovate the units, it increases the value of the property, which increases the capital at the end, or the equity at the end. So these are just basically
we'll be showing that. We'll be showing a better example of that next month at next month's meetup too. So
yep. So these are just basically the four key roles. There's small jobs, with investor relations and things like that will be, other outside of this, but this is basically the 4 key roles.
This is what I really like. We touched upon it earlier. This is like what excites me about syndications. Like when we first found it many years ago, 3 years ago, it's all about what you absolutely love. I like to call it the unique abilities of the actual GP partnership sponsorship team, that you don't have to be an expert in every one of these. Yes, you have to know a little bit about each one of them, but you partner with people who are, and this is what they love. And so our hunters love, that's it. That's all they like to do. They like getting out of bed and doing that. And then the underwriters, they underwrite deals, but they don't want to be raising capital. So you don't have to be an expert in everything. You just need to be able to provide one piece of the puzzle when you're doing these syndications. And like we mentioned, JJ's the hammer. Well, Greg does a little bit of the asset management. He enjoys it, but he doesn't enjoy it as much as JJ does. And so that's what's awesome.
I don't know if that's true, Brett. I don't think that's true. Asset management is actually where I've really found my groove, but at the same time, it's not where I want to spend all my time. So that's when the time thing comes into equation for me personally. So, but you're spot on.
You got to find what you love and then be able to dive deeper into that specific piece. I love getting out there telling people what we do and why we do it. And that's why, and you've got to have a large investor group that you're able to do that with, and then have systems placed, a CRM, and we'll talk about that in a later, meetup. But those are the types of things that you got to have in place in order to make sure that each one of these pieces falls into place.
Yeah, so one thing I do besides doing sponsoring deals through BluSky Equity Partners is I'm a multifamily investing coach for one of the programs that's out there. And I always tell people that putting together a GP team is like putting together a puzzle. You got to find all the right pieces that fit together right to make what you're trying to build. You have to find the right people with the right skill sets, with the right proclivities and the right temperaments that work well together. And then obviously have the right financial attributes also to be able to qualify for the loan, and have the depth of reserves to be able to, if it came down to it, put money in to shore up a deal that might not be performing so well, for example. So that's what we mean about building a puzzle, and this all works well together. We have one question in the chat from Ari. He says, how do you guys handle differences when there are issues that come up? For example, when the brain has an issue with the hammer, are there voting mechanisms in place? Well, so voting mechanisms might come into place on a particular deal when we structure an LLC. But as far as just us working together, it's really kind of, we just kind of hash it out. One of the people who I listen to, she tends to say that, hey, sometimes when GPs have a disagreement, at the end of the day, you just got to hug it out, and that's kind of what it comes down to. I don't know if you guys have any other perspective on that.
I don't hug it out. I tell Greg that I want to get into the octagon and we get after it. I mean,
please.
No, you got to really be, if you're not a brother, like that's what it is. Like you got to be able to have good, tough skin, because guess what? Like there's times you screw up, and you got to be able to take it and be able to handle it as well, to have that good feedback. And so the feedback mechanism is just like the communication concept of it. I mean, it's a relationship. JJ mentioned it earlier, that you're married to this person. You better know that you can handle it and get through situations that are probably some of the most difficult situations that I've had to deal with. And one of our 60 units in Fort Worth, it's been nightmare in certain instances because of the circumstances, the economy, whatever the case may be. But you know what we didn't do? And I wouldn't have gone into a deal with these guys if I didn't know this, that we didn't quit. And that's the most important thing, is that you have what Jonathan mentioned there, is those core values that you're not going to, like, and trust those people with your life, if you will.
Yeah, we don't just go out and do a deal. I see a lot of things on Facebook. People will just jump on a deal with syndicators and they don't even know who they are. So I have to know, like, and trust you, and we've built that relationship over the last 2 or 3 years. So it's a process.
Let's move forward, guys, because we're running short on time, and I want to respect everybody's time. So let's go ahead and get through these.
So resources, the financial net worth, like we touched bases a little bit. Like, to get the loans, to invest in your own deals, you got to have the net worth liquidity, and you got to keep it. You just got to look at to keep the poorly performing deal afloat. You've got to have that money, and not all the deals right now on the market are performing. And so the GPs on the deals have to start sticking some of their own money in. So you got to make sure that you have the financial capabilities.
And I want to caveat that right now, real quick too, is it's not that there's a large number of non-performing deals in a normal time, but the deals that people got into in 2021, 2022, before the Fed started hiking the interest rates up, suddenly those didn't end up looking so good. Once when between interest rates being at 0.05% and being now at 5.25%, 5.5%. So that had some negative effects on the real estate market. But before that, like, a poorly performing deal was a rarity, and it only happened really because of poor asset management. And when in a market where the tide is rising, cap rates are compressing and values are going up, that can override poor asset management, and you can still make money despite that. But in a market like we're in today, you can't. Asset management's absolutely critical. So my soapbox. I want to put that perspective.
Yep. The education skills, we're all part of masterminds, we're part of groups. We keep getting experience on a daily basis. And so you just want to make sure that the GP group that you invest in, and yourself, if you want to invest in as a GP, make sure you have the right education and a mentor. That's important. And a strong network. We're constantly networking every day. You're trying to sell yourself online, Facebook, emails. You're out there networking every day. You just don't even know it. So
Yeah, that comes into play as far as your ability to raise capital for the deals, but also your ability to find the right partnerships to get into these deals. And there's just the saying is your network is your net worth, and it's absolutely 100% true.
Absolutely.
So many different ways that your network can it can help you find resources that you wouldn't know about otherwise that can help improve your operations or your structure. There's any number of things. So, okay, I'll take over from here for commitment, and this is really about if you're going to be a general partner, you have to be willing to put your investors' interests above your own. You have a fiduciary responsibility in most cases to your investors, so you have to take that seriously. You have to commit to the highest ethical conduct. You have to communicate routinely with your investors when things are going well and when things aren't going so well. And there's a lot of general partners that I've seen who, if a project isn't going so well, they disappear in the woodwork and they're afraid to communicate with their investors. And that's the absolute last thing that should happen. When things aren't going well, that's when you should be communicating more often. And that's going to give give the limited partners, the passive investors, more of a sense of surety that, hey, these guys are at least all over it. They're taking it seriously. They're doing things as best as they can. Besides that, obviously you have to continue learning all the time. You have to be a lifetime learner if you're doing this. We mentioned before about you have to be willing to loan money into a deal to keep it afloat. And I've never done that until the last year or so. And now I have a couple of deals with floating rate loans from before the rate hike started where I have had to do that. So it's something, when it comes down to it, here's the line, JJ.
There you go.
Have to
Take
be
it,
willing
Greg.
to take bullets for your investors. You have to be willing to do that. You have to consider yourself in a position of leadership that you are helping shepherd these people, and you're responsible for their capital. And if that doesn't make you pause for a second and consider the gravity of it, then maybe being a general partner isn't for you. That's it about commitment. Real quick, wrapping up, general pros and cons of each. So on the general partner side, you have higher profits, more income streams, more control over the deal, the opportunity to build a business, easier to qualify for real estate professional tax status, and it can be a faster change to your financial situation potentially. I say potentially because if a deal is going negatively, it could have the opposite effect. Okay. Cons are it is very time intensive, and you have to balance that out if you still have a day job at the same time. Self-funding of business expenses for some time until the money starts rolling in. That can add up depending on how long it takes and the market conditions at the time, and more risk. On the limited partner side, pros are little time required whatsoever. It's really about networking and finding those sponsors that you really trust. And then understanding how to really analyze a deal, so you understand what it looks like, what a good deal looks like, and what a bad deal looks like, and you're smart enough to know the difference. Pros, others are doing the work. This is kind of a corollary of that. You're not the one doing the work, and there's less risk as a limited partner. You're not a guarantor on the loan, so the maximum amount of loss at the absolute worst situation would be whatever amount you invested, and very rare that happens. Cons would be the profits are limited to the limited partnership returns, of course. You have less control because you're trusting in the general partners to control that deal, and as part of that same thing, low decision making ability. So which path is best for you? What do you guys think? Here's unmute yourselves. Anyone have any thoughts? Where are you at? What are you thinking?
Seen a couple guys on here said that they want to be GPs.
Jonathan Wyatt, I saw he's already getting into a GP deal right now in Dallas area himself.
Nice.
Yeah. Hey, fellas. It's Gabriel. Thank
Hey,
you for
Gabriel.
just taking the time today for sharing all this information. Yeah, actually, me and my wife, we started about 7 or 8 months ago to get into the multifamily realm. We were just about to get into single family, and then one thing leads to another when you start doing research and investing, and then My wife, she's a realtor. She's been in real estate for over 5 years now. So she's seen the ups and downs, and she's had a lot of single family investors come through her portfolio, and she's heard all the good and bad from it. And so we decided to go the multifamily route. So this is where we're at, and it's one reason why I'm on the call right now, just to get a little bit of insight on how you guys are actually doing it in Tucson. Actually, one of our coaches, I'm not sure if you guys are familiar who Ivan Vien is, but he actually told us to reach out to you
Very
guys.
well.
Yeah, and just I wanted to actually get some insight. I believe you guys are going to talk about. I'm not sure if not, maybe we can schedule something else after. But what about your guys' deal that you guys have going on, the 94 unit? I believe it's you guys bought it at over an 8 cap. Is that correct?
That is correct.
Wow. Okay. Yeah. So, yeah, just because how things are right now with, deal flow kind of drying up, I just was hoping to get some insight on how you guys are going about, you know, finding deals and things of that matter right now.
Gabriel, the one thing that I can recommend that has helped us significantly, because we had that same question several years ago, is the boots on the ground and the folks that we have that are local there to the submarkets of Tucson or DFW, and then JJ being in Southwest Wyoming. So that would be my recommendation, is that you have the insight of that local market, because every submarket, as you can attest to, is very different in some metroplexes. So I highly recommend having that individual who's boots on the ground, who understands it very intricately, and that's what's been most beneficial on our end. Greg, JJ.
Yeah, that's the person that's sourcing your deals. You got to have them broker relations. They're gonna be the ones that you got to have a good relationship with them, and start getting serious with putting your offers out, and they know the ones that are serious and the ones that are not. So that's the main thing. Just start building those broker relationships up.
Yeah. And Gabriel, we can talk offline about the Tucson deal, how we found it, and everything like that. Really, it was other people who brought me into that. So I've got 8 deals as a general partner under management right now. I'm not an asset manager on all of them, but I am on 5 of the 8, and that ends up taking a lot of time. So I've kind of lost the capacity to do a whole lot of deal searching myself.
Yeah.
So I'm kind of trusting. I'm kind of reliant on others bringing me into a deal. Which has been another reason why Brett and JJ and I are talking about potentially partnering up here in the near future, and maybe we can build in a structure where we have that within our team. We're just not quite to that point right now. So
cool.
Yeah,
sounds good. Yeah, my wife, she's actually really good at reaching out to brokers and things like that, and we recently got some the listings of people, the owners of the buildings right now. So we're actually in the midst of cold calling. What is your guys' take on that? I'm sure it's okay if I ask another question, but as far as actually cold calling and reaching out that way, we're using like the CoStar reports and everything.
Yeah, I think I'd never heard of doing that until recently, because people just weren't selling that way. But right now, I think it can be good, especially if you get one of the lists out there that so the lenders can provide you of deals that are in distress. That's a good way to go about going direct to owner right now, is to give an owner a way out, identify if they're looking to sell, and help identify a way where you can do a win-win deal where they can cover their basic interest while you're still getting at a fair, decent price basis for where the market is right now.
Yeah, that makes sense. Definitely.
Also, I think the direct to seller thing tends to work better for smaller properties. When you start looking at like 100 unit properties, then you don't see as many selling that way. But it usually goes through a broker. But it certainly doesn't hurt to try it. Typically, it's going to be smaller properties. But I think JJ, you guys have had success with a little bit of that up there in Wyoming, right?
Yeah, we have. And it was like Greg said, it was a 23 unit property, but we were able to grab it and do a joint venture on it. We didn't have to syndicate it. So It's just lower amounts, and just we had it on a seller finance, so it was kind of an off market deal as well. So, but the smaller deals will work too. They make money, and so that's the one thing, Gabriel, is you got to think is, if you got your buy box picked out, do you want 20 to 50 units? Do you want 50 to 100 units? C class properties, value add. That kind of narrows it down of what you guys are looking for. With your wife having that experience, she probably has that lined out, but.
Yeah, she has it all lined out and everything. Yeah.
Fantastic.
Awesome.
Cool. Thank you guys.
Yeah.
Any other questions or input from anyone? Anyone thinking a certain route or have any questions?
Or anything that we didn't answer that is biting at you? Like, we would love to hear your feedback and get answer any questions anybody may have. Really good questions.
Don't necessarily have a question, but I did want to say thank you for inviting me. It was a good time, very good presentation. It's confirmed a lot of the things that I have already been learning on my journey to becoming a GP. I really appreciate you guys.
Fantastic. Happy to be here to support you and appreciate it, John. Appreciate it.
Hey guys, like I said earlier, I'm interested in 1031 exchange strategies, and so maybe I could. I've got Brett's contact info. I could contact you offline and talk about some alternatives. And I heard the word joint venture. That might be a good opportunity sometime if I'm bringing quite a bit of 1031 funding. See, right now I'm managing all my properties myself. I've done almost everything myself, acquiring them, managing them, maintaining them. I do all of it, and kind of a single point of failure. And so I'm feeling uncomfortable about that.
It's a lot of work, isn't it?
I don't mind the work. I'm happy doing it. I love that I own all these properties and the cash flow is good, and I'm happy about it. But I do feel like there's a lot of risk because like I said, I do everything myself. So I'd love to be in some kind of a joint venture with somebody so that there's some coverage. If I was to get hit by the proverbial bus,
Right.
somebody would know the password to the software to manage the properties and help the business carry on, so. And I like to leverage some smaller properties that have really significantly appreciated and take all that equity and put it into a much larger property that would support more management and more of a joint venture situation. So
because of the topic tonight being about, difference between, limited and general partners, this is by nature talking about syndications, but absolutely, and with syndication, it makes it a little bit more difficult to take a 1031, not impossible, but a little bit more challenging, but much easier as a joint venture. As a JV, you don't have to worry about syndication. It's, you're just partners. So that can be a much easier way to bring a 1031 into something.
Yeah,
absolutely.
Yeah, John.
Sorry, I was also thinking about a strategy where if you had an existing property, maybe 100 or 200 units or something, and you needed an injection of cash for maybe some capital improvements or something, if you sold me an undivided interest as a tenant in common in that property, I wonder if that would work somehow. It'd be easier than us trying to throw a tick into the syndication if you sold me an undivided interest of the property you already owned.
Yeah, that is possible. I've heard that as a way people are doing things these days, but I just caution you that typically if the deal is in that situation where they're needing that cash, there's a reason it's already in some amount of distress. So you have to just be careful on, will that cash injection be enough to carry through and finish the business plan such that you will get your principal and your return back,
But to piggyback on that, John, we do have projects in our Wyoming market that we have a phased approach. So we had phase 1, we did phase 1, we did phase 2, and now we're looking at phase 3, and we just kicked off phase 3 because of similar what you just said, John. We had an infused capital that came in, and we have a business plan designed for that we're going to actually take 4 additional units and then showing what the return on that was for the infused capital. So that's what's awesome about real estate. There's so many different opportunities to do that. We just get our lawyer involved to have us make sure that we're dotting our I's and crossing our T's.
Right.
But yeah, I'd love to get on a call with you and talk more about it.
Okay, yeah, I'll reach out to you, Brett. Okay.
We're a bit over time, so I'd like to get this wrapped up just to respect everyone's time. What did want to mention real fast, and Gabriel had asked about this. Just wanted to put a plug in about our deal we have right now. This would only be, potential for people who are already in our investor clubs, already have a relationship with us. If there's anyone on the line who's not in our investor clubs and is just visiting, and again, more than welcome to invite people to these things if they know people who want to learn more about this stuff. But anyone like that would not be able to invest in this particular project, but certainly reach out, build a relationship with us so we could get people into one following this. So with this property, this will be my 4th project in Tucson. It's 94 units, Class C plus. So it's in a great part of town, right, real close to downtown, less than half a mile from the University of Arizona campus. We're buying it at a 30% discount from where it was a year ago. We're able to do this because of the pricing coming down, thanks to the interest rates, but also because of an ownership divorce. The owners are big. Their partnership is dissolving. This is the last property that they own together, and they've already gone in separate directions for new properties they're working on separately. And they want to get out of this one. They thought they were going to sell it last year, and they didn't get to because it fell out of contract. So we were able to get it at a really strong discount, which means there's instant equity in the property as we, the day we close. We also have the opportunity to add 17 new units on this, which is a pretty surprising and unusual opportunity. It's because there's 17 4-bedroom, 2-bath units that can be split fairly easily into separate 2-bedroom, 1-bath and 1-bedroom, 1-bath units. So that alone is expected to increase the value of the property by roughly $1.5 million. That's in addition to the equity that's somewhere between $1.5 million to $3 million, depending on what cap rate we look at, that we already have when we close. So you can see what the financial projections look like. I'll say that I believe these projections are fairly conservative. And so if there's anyone who might be interested in this project, feel free to reach out to us for more information. We can make sure you have access to our slide deck about the opportunity, our webinar recordings, and give you, have a conversation, answer any questions, so you can help identify if this might be a go or if it's a no for you. So other than that, we appreciate y'all coming. The next one we're going to be doing here is going to be on Wednesday, May 8th, same time. And the topic of that is going to be how multifamily properties make money. Just since there's 3 different QR codes on one screen, it gets a little bit confusing. I want to say this one right here, this top one is for registration for next month's meeting. And of course, these bottom 2, this is just if you're not on our investor clubs, and you'd like to possibly do that, or at least have a conversation with us, you can use either one of those QR codes to get on our calendars. So, Brett, JJ, anything else you want to say wrapping up?
No, just mainly is thank you so much for all the discussion in today's webinar. Mainly, please drop your contact information so that everybody on the call has the ability to access that information at a later time. That if we have cross communication, the more information that we can put out there, the better. And at any time, if there's something that pops up in your head that didn't get answered here tonight, feel free to reach out. We love to help out our tribe. And most importantly, I know everybody on this call has family or friends that are interested in learning more about this.
Right.
Have them please join our next one.
Yep. That's what I was going to say.
Absolutely.
Too. Absolutely. Thanks, everyone.
Y'all have a good evening.
All right.
Appreciate
Thanks,
it.
y'all.
Brett's like,
All right.
peace out.
Yeah. Yeah, Brett's like, peace. I didn't want to turn that off until everyone was gone, unless you were just going to end the meeting. So